My name is Untitled, and chances are you have not heard of me. However, you will be glad you heard from me today, because I am going to amaze you with a different view and show you why you have been losing money in the stock and financial markets. I have had the opportunity and the privilege of trading the markets for over 3 decades now, of learning trading from some of the best traders in the world, and the opportunity to share my discoveries and methods across the globe in 4 continents and many countries. To present hands-on trading workshops and seminars to over 4,000 traders and investors hailing from the US, Europe, Asia, and Australia. Today, I live a life of plenty, a life each one of us dreams of. A fabulous large house staffed to make my life so comfortable. A dream car, holidays all over the world, and never having to worry about money for the rest of my life. I have made the markets my ATM, a self-reloading ATM. You too can. And all this has been possible with a few discoveries I made about the markets. The secret language of the markets, a method so simple, so elegant, and so clear. You will be surprised to learn that every one of us can make the money we so desire. Your desires can all be fulfilled. You too can live the life of your dreams. Before I go into the presentation, let me tell you a bit of my experience in the financial markets. Like most people, I too started with knowing nothing about the markets and jumping headlong into trading. The result? Nothing different from the average trader. I too had my moments of euphoria and moments of abject failure, of making a lot of money and losing a lot of money, letting my losses run and covering my profits too soon, seeing my stop losses being hit, only to discover later, had I stayed in position, I would have made a lot of money. And as like most of you, next time I did not respect my stops and seen my account being wiped out. I was the regular victim of the market, one who gets trapped and loses most of the money. Always wondering, is there a better way? Do people really make money in the markets? On first glance, it appears very simple. Stock prices have to move up or down, and one can either buy or sell. What can be more simple than that? There is a 50-50 chance of failure to success. Alas, it took a few years and humongous losses to understand that it is not as simple as it looks, unless you know the real language of the markets. And then I heard about Albert Einstein, the most intelligent and the most logical, and his experience in the stock market. He invested most of his 1921 Nobel Prize money in the stock market, and he lost most of it. Now, my thoughts were, if Albert Einstein could not make profits in the market, do average people like me have any chance? Does anyone really make money in the markets? Is there a surefire way to make money in the markets? Not willing to give up, I embarked on a journey of discovering how the markets work, and it appeared so perfect. I felt once I learn these methods, I will be making money like the masters. After all, if they have done it, I too can do it. I bought a bunch of books and immersed myself in learning. I set about learning the different ways of trading the markets, and within a couple of years, I was back to square one. All the knowledge I gathered gave me no wisdom, no real way of knowing what is about to happen, which way the markets are going to unfold. Not a thing changed in my trading. It was the same. I appeared to be wiser, to know more, and could explain everything happening in the market, just like we always do, after it has happened. But it gave me no edge, no advantage, no practical way of making profits. Yes, I now sounded intelligent like the so-called experts on the television in the media. But was I making money? Showing profits in my trades? No. Not a single cent to show for my effort. Trading was still the same. I am sure most of you have gone through similar situations, felt the same emotions, sometimes getting desperate, wringing your hands in despair as you lose your hard-earned money. And then, one awesome evening, I had an angel show the way, throwing light in the most unusual fashion. She was then just 13 years old. And as I was studying the markets, she came and pointed out the secret message of the markets. While not knowing what she was saying, but one simple sentence changed my life. The secret of the markets that was well hidden right in front of everyone's eyes in broad daylight became clear, and I started viewing the markets in a different light. I spent the next 6 months re-looking at the markets and discovered how easy it is to trade the markets, just following the hidden order, the hidden message of the markets, and putting profits in my account again and again as I watched my account grow in a matter of just 51 trading days. I had a 107% profit, and I realized I was onto something big. And it has been a one-way journey from then on. Let me tell you now, there is a way to make consistent profits, consistently making money, to be on the right side of the markets, and show phenomenal profits. Profits you never thought possible. Profits you never imagined. Profits that will let you live the life you dream of. And take this small journey with me today. Stay with me till the end of the presentation, and I will show you how you too can become the successful trader. You too can make the markets your self-reloading ATM. And you too can live the life of your dreams. You will be living in a house you dream of. You will become a profits-attracting magnet. I have even taught a 7-year-old child to read the language, so you can imagine how easy it will be for you. The markets are simple. We make them complicated. Primarily, all of us pick some wrong ideas and notions of the market. Right in the initial days, through the media, listening to the so-called experts of the markets, reading the free stuff, and in our journey of trading, we pick up so many ideas, notions, and logical explanations, and these are the very ideas that hamper our way to profits. We all agree, and we hear this often, the markets are illogical. They appear to not follow any rules and appear completely random. We all agree that there can be no logical explanation to the markets. They seem to defy every known logic and flummoxed even the most logical of men. Yes, when it comes to our own trading, we approach this illogical problem from a logical standpoint. If logic were to yield us trading profits, then every person approaching the markets from a logical standpoint should be making regular and consistent profits, and mathematicians would be billionaires. But we see the opposite to be true in most cases. But like a blind bat, we still continue to seek logical solutions to this illogical problem. Don't you see that this approach is doomed to failure right from the beginning? Don't you feel this approach will only lead to more regret? Think about it. Now, in this presentation today, I will show you the 3 common illusions. Illusions in the financial markets. Fundamental analysis. When does it work and not work? technical analysis. When does it work or not work? Magic of the markets. What drives markets? What skills are required for trading and investing successfully? Let us now understand how we are led to believe what we see and hear. Look at this picture. What do you see? What comes to your mind instantly? A lady's butt? Interesting. See carefully, and you will realize these are heels. Very interesting, right? Even after you know they are heels, you can still see the woman's butt. Now look at this picture. What do you see immediately? A bottle? A loving couple? Erotica? See carefully. Print is always black on white. And here we are misled by our choices, our wishes, and what we wish to see the most. Basically, there are only pictures of dolphins on this image. Dolphin, 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 dolphin. Now let us see the next illusion. Which car looks bigger? The last one? I can tell you straight away. All of them are of the same size and dimensions. Yes, our brains play these tricks on us. It is a matter of perception. And even now, after knowing all of them are the same size, what do you feel? The one at the back is the largest of the three, right? The markets also play such games on us, and we are led to believe something is a fact when the exact opposite is true. More of that later. Now, see this picture. Who do you see? Did you say Albert Einstein? Are you sure? Pay attention, and you will also see, yes, Marilyn Monroe. Really? No, that's Albert Einstein. No, that's Marilyn Monroe. Oh, this is really confusing. Can it be both? Our eyes playing tricks on us again? Now, all these pictures illustrate how we get misled in the markets and listen to the so-called experts who really do not understand the market too. And in the process, we lose our hard-earned money and give away our precious capital and only end in despair. I will show you all that by the end of this presentation. These are the visual illusions. The next kind of illusions are the illusions created by movement, and we have absolutely no control over it. Most traders tend to watch the trading screen all through the day and keeping constant track of the price movement. This creates the illusion of movement. See this picture and look only at the black cross in the middle. What do you see? Keep looking. Wait, the flashing pink dot is changing color. Keep looking. And suddenly, all the dots seem to vanish. Really? Blink your eyes and see attentively again. Does the pink dot really change color? No, not at all. Do they disappear? Absolutely not. So, what is happening here? Why is our mind playing these tricks? This is exactly what happens when we keep looking at the trading screen. The next one is the killer. It causes more frustration and more losses than the other two, and is responsible for making paupers of most of the traders. And that is the illusion of thought. What is written on the board? T-H-I-N-K. Think. A very simple and a word we all use so many times in a day. Now, let me ask you a simple question. What is the meaning of the word think? Be honest to yourself and do not look up a dictionary or the internet. Answer the question. Hit pause here and seriously try to answer the question. Do you know the answer? No. You are at a loss of words. Cannot express in English? Express in any language you can. But you need to explain, not translate the word. Still cannot explain? No? Surprised? You are not the only one in the world. 99% of people cannot explain what is thinking. And yet, day in and day out, almost every moment we use the words, I think, without even knowing what it means. And we use it in many different ways. What a pity. Sometimes we don't even mean what we say. We carry a number of such illusions about the market. It will be clear as we move along with the presentation today. Now, these three illusions haunt us every day as we trade and invest in the stock and financial markets. The optical illusion, the illusion of movement, the illusion of thought. Let us now look at our belief and our assumptions about the market and see how they truly mislead not only you and I, but millions of investors and traders worldwide. Fasten your seatbelts and prepare to be surprised and your fondest trading ideas shattered. Central bank interventions. Around the world, almost all investors and traders appear to have a fetish to observe the central banks, monetary authorities, and government actions. Many a time, our belief appears to work exactly as we presume. And a greater number of times, the markets seem to have a mind of their own, appearing to defy all logic. Thus, our belief, if scrutinized under cold hard facts, are totally unfounded and fallacious. Yet, we do not hesitate to put our hard-earned money on our belief. All of us believe central banks with their open market operations affect the trends in the market, and they can really change the trend of the market. Let's look at one such scenario. The biggest of such announcements was made by the US Fed on September 18, 2008. After market hour, the Fed announced a package of $1.2 trillion. Now the US Fed is the biggest and the largest granddaddy of all funds and monetary authorities. This is how the markets across the globe closed on September 18, 2008. What would you think happened when markets opened on September 19, 2008? As expected, no one had a clue of the Fed's actions, and the next morning, markets across the globe opened almost 10% higher. Investors and traders rushed in to buy. Bears closed their short positions, and what must be noted is, markets opened with a gap. And all traders or investors following the news for their trading decisions could only establish a position on open, that is, 10% higher. What do you think happened to them? The biggest open market operations and such a huge allocation. All the people long should have made tons of money, right? Wrong. Markets started their downward trend 2 days later, and after 1 month, on October 25, 2008, Lehman Brothers declared bankruptcy, and markets across the globe posted a low 30% below the levels of September 19, 2008. What went wrong? Why did the biggest infusion of money into the system fail completely? Why was the Fed totally ineffective to counter the forces controlling the market? Does anyone really control the market? Serious questions to ponder about. The whole world awaits every quarter to hear about the Fed's decision on interest rates, the European Bank's decision, tracing interest rates across Australia, Japan, China, Europe, US, Canada, and whatnot. What do you believe? What is the effect of interest rates on the equity markets? On the commodity markets? While I agree it affects the bond markets, equity and commodity markets can be seen to be at their volatile best when these interest rate announcements are made. Most traders believe that there is an inverse correlation between interest rates and the equity and commodity markets. Rising interest rates are detrimental to profit and therefore to the performance, and therefore to stock prices too. And declining interest rates are met with cheer, with a strong belief that profitability will increase and there will be an upward movement in stock and commodity prices. Have you ever wondered the true fact? Nothing can be more untrue. Yet, we will hold on to our beliefs, even at the cost of losing our hard-earned money. It is our nature to cling to our beliefs. At the risk of survival, it's intrinsic to us. More about this later. For now, let's look at the facts. In the year 2000, during the dot-com boom, when markets were marching relentlessly ahead, the Fed rate was at a high of 6.25%. And then, the markets corrected, went through 9/11 attack, took a lot of beating. And what was the Fed doing? Lowering interest rates, all the way down to 1.13%. Did this change the trend of the market? Not at all. Markets changed the trend on their own. From 2003 to 2008, the upward march was on. And how did the Fed react? By increasing interest rates. For 17 quarters, they raised interest rates. But the relentless march of the markets was on. And in 2008, interest rates reached 5.75%. Rising interest rates lead to lower equity markets. Really? Or is this a fallacy promoted by vested interests? Hit pause and think for a minute. Welcome back. I will show you more. Now in 2008, markets started moving lower. And by the end of 2008, where did the interest rate stand? At 0.25%. And what were the markets doing? Heading lower and lower. Interesting? When we step back for a minute and see what is happening, interests do not appear to influence the markets, but it is the other way round. Markets influence the interest rates. We have got into the habit of putting the cart before the horse and expect our cart to move forward efficiently. The entire approach appears suicidal, to say the least. The fool and his money will be easily parted. Rising interest rates signal a healthy economy that can pay for the costs of doing business and are to be considered good for higher prices in the future. And lower interest rates only indicate that the markets are not conducive to growth and are most likely to be in a declining mode. Either ways, it is the markets that will determine the trend and the interest rates in the future, and not the other way round. Here, I present a comparison of CNX India Nifty with the Reserve Bank of India base interest rates. Don't get fooled by the pundits and the prophets. See for yourself. Crude oil. What is the effect of crude oil prices on the equity and commodity markets? What is your belief? Are rising crude oil prices detrimental to the equity markets? Do lower crude oil prices aid a bull market? All of us appear to have a fetish to look at the crude oil prices and assume we will be able to forecast the market direction from the trend in crude oil prices. The media also adds to this confusion. Every day, you can read and hear about rising crude oil prices, or that crude oil prices have suddenly taken a nosedive, and how this will positively or negatively impact the equity markets. The biggest input in most businesses is logistics and transport and the movement of goods. We believe that higher crude oil prices will negatively impact profitability and will lead to higher inflation, and thus will reflect on the equity markets negatively, and vice versa. Nothing can be further from the truth. In 2000, crude oil was trading at a high of $37, and all equity markets around the globe have been trading higher, perfectly synchronized with crude oil. Then, towards the end of 2003, when crude oil was trading lower at $26, all equity markets were trading lower, again synchronized. Now move ahead 5 more years, and you see a rally of over 500% on crude oil prices, now trading at $147. Lo and behold, inexplicably, the world equity markets are also ruling at the highs. The crash of 2009 once again saw crude oil prices trading at $40, and magically, equity markets also are trading lower. See for yourself the years 2011 and 2015. Strange, isn't it? We believe the exact opposite to be true. Time and time again, markets present these insights to us, and while they appear absolutely illogical, they appear to have a logic of their own. I will elaborate more on this phenomenon later. Prices of gold and silver. We hear these statements often. Money is moving from the equity to commodity markets. The weakness in the commodity markets brings money rushing back to equity markets. What is your belief? Does money really move from equity to commodity markets, and vice versa? Look at the chart below. Here we can see prices of gold, crude, silver, euro, dollar, Dow Jones, Industrial Average, and India Nifty. In 2003, when gold was trading at $233, silver was trading at $4.36, euro trading at par with the US dollar, and crude trading at $26, the equity markets were trading at the lows, once again synchronized. In 2008, all of them are ruling at the top. Once again, in the end of 2008, early 2009, all of them are trading at their lowest, and yet again, all of them trading at the highs in 2012. Come 2015, and we see the commodity markets trading lower. And what do we see in 2015? Lower equity markets in fear of Brexit and whatnot. Today, as we stand at the end of 2017, once again we see commodity prices on an upswing, and the media and pundits already warning us about impending doom. Who do you want to pay attention to? The markets that ultimately dictate the prices, or the pundits and prophets who do not appear to really look at the facts? Analysis of earnings. Analysts lag reality. The chart needs no explanation. The red line indicates S&P 500 earnings, and the black line the forecasts of the so-called analysts. See for yourself. Where is your money? Here is something I want you to ponder about. Assume 3 entities, A, B, and C, represent the whole market. Entity A has 1 million shares of ABC. Entity B owns 100 shares of ABC, and Entity C is interested in ABC. ABC is currently trading at $100. Entity C requests Entity B and is quoted a price of $150. They come to an agreement on the prices, and the deal goes through. Now, what happens to Entity A? He is sitting quietly with no involvement in the trade. He is suddenly richer by $50 million as the new price is $150 a share. How much money changes hand? A meager $15,000. Yet entity A is richer by $50 million. Interesting. A few months later, as the price of ABC sees no trading and the price remains constant, Entity C, in his frustration, requests Entity B to buy the 100 shares of ABC. Entity B says he will buy at $80. In his frustration, Entity C takes a loss and sells the shares to Entity B. The new price for shares of ABC is now $80. Entity C lost exactly $7,000 in the whole trade. What happened to Entity A? He now sees a wealth erosion of $70 million. This is exactly what happens in the markets every day. Less than 5 to 10% of the total shares get traded in the markets every day, and this trading affects the rest 90 to 95%. Now, what is the true value of ABC? $100, $80, or $150? Think about it. This phenomenon is repeated in the markets every trading day. We hear of market capitalization and wealth creation. Does money come in? Does money go out? Or is the market simply a game of numbers and an efficient way to transfer wealth from one participant to another? Technical analysis. So far we are looking at the logical fundamental ideas that we believe affects the markets. Let us now look at the other branch of market analysis, that is, technical analysis. A study of price charts, volume of shares traded, and several derivatives of price and volume that we call indicators. Do you use any of these to aid your trading decisions? A stochastic oscillator, RSI, MACD, Bollinger Bands? Do you really know what they actually indicate? Do you know how they are calculated? Do you know when they are to be used and when they are to be ignored? I am confident most of the normal traders like you simply use these indicators because you have heard about them or because they are provided free in your charting software and never made an in-depth study of how they are to be used. You have only curiously glanced and picked up a couple of ideas and started applying them without knowing them perfectly. Not knowing and studying them in detail, we tend to lose our hard-earned money and come to a conclusion that these indicators do not work. It is akin to using a pen like a knife and then complaining that it does not work effectively. Almost all indicators will show you the right direction to trade when they are used in the manner they are designed for. Gaps. Most traders have heard of gaps, and we hear the words, "Markets opened with a gap today," indicating either bullishness or bearishness in the markets. We then form our own opinions without even understanding the importance of irrelevance of the gaps. There is one more erroneous view among the traders that the gaps are filled, when the true fact remains that not all gaps are filled and there is a lot to learn about gaps. A simple question I would like to ask you, the reader, here. How many kinds of gaps are there? Surprised? No, the answer is not gap up and gap down. Think about this. You have never asked this question. Until you know the real answer, you really do not have the understanding to trade the market using gaps. To answer, there are 4 kinds of gaps: common gap, continuation gap, breakaway gap, exhaustion gap. This brings about the next question. How do we identify them? How do we trade them? How do we know which gap will be filled? Let us understand them. Common gap has no practical view. It appears in a trading range. Continuation gap. typically is the midpoint of a developing trend. Breakaway gap. This indicates that a new trend is beginning and appears when markets move away from a trading range. Exhaustion gap. This gap is typically the third gap in a series of gaps when the market is trending. This is the only gap that gets filled quickly. Thus, you should note that only one among the 4 kinds of gaps gets filled. Any trader who is trading every gap to be filled would only be successful 25% of the time. Surely not a good trading strategy without a complete knowledge of the theory. Overbought, oversold. You have heard these statements quite often too. The markets are severely overbought and we should see some correction. And also its other variant. Markets are now in deep unsold territory and we should see a bounce very soon. What exactly is the meaning of these statements? The total number of shares remains the same and the number of shares owned remains the same. Does this overbought or oversold really mean anything? Can it give us a trading edge? The truth is, such a condition simply does not exist. It only makes the person saying it look smart and intelligent, when in truth, the opposite is the case. How many times have you seen the markets continue to rally in the so-called overbought conditions? And how many times have you seen the markets decline in the so-called oversold conditions? You know the truth yourself, but have never pondered to think if your understanding was correct. My definition of overbought is, the person saying the market is overbought has no holding and he is ruining the fact that the prices have moved higher and he is not able to participate in it. And oversold, the person is left holding the shares and prices are declining much farther than what he has expected. Open positions. When is open position highest? When is open position lowest? We have seen a lot of discussion about open positions in the derivatives segment, but we always appear to ignore the fact that every open position is in fact closed from an exchange perspective. When do you consider the open position to be the highest? Is there a quantifiable way to calculate it? In my 3 decades of trading, I have never seen open position to indicate the future market direction with any certainty. It can always be explained once past the time, but we cannot go back in time to establish a trade. Hence, I believe it is a sheer waste of time and energy to study open positions to gain any certain knowledge of the markets. In conclusion, I could go on and on about a lot of these ideas that we see discussed every day. Markets do not work to a logic. Ponder on that point. It should be one of your basic questions. If the markets were unfolding to certain logic, why does everybody not make money? In the next segment, I will address this question in detail. What drives prices? What is the single factor that drives prices in the markets up or down? Think back to a time when you were buying an instrument. How many times have you made a decision to buy or sell based entirely on your emotions rather than the logical process? You are not alone. Every trader, every investor, and every fund, while having their own parameters and rules to be considered for trading, when it comes to executing the order, we look at the prices and in the last second, we take a trade. Many a time we have made up our mind to buy a stock, but when we find the prices are in a marginal decline, irrespective of our study, we listen to our only emotion, the emotion of survival, and we sell a stock we wanted to buy. Or at best, we decide to stay away, only to see the stock rallying away and regret our decision. The only true emotion that drives this market is the fear of losing and the stronger emotion of greed. The truth is, markets will go up as long as there are traders willing to pay a higher price in the hope of selling at a higher level at a future point in time. And markets will keep declining as long as there are people who fear the present price may not be seen in future. Professional trading skills. Having observed successful traders over the last 3 decades, it can be said that there are broadly just 3 skills or areas which are the most important for putting profits in your account. Trend change and trend continuation. The average retail trader and also some large traders have a fetish to chase after a trend change, and in their quest for that one trade that gives them that perfect trade, miss out on several trades that can put profits in their account several times. The sensible professional trader, however, is always on the lookout to find trades that indicate a continuation of trend. While trading the continuations, they are aware that they will lose money on some perfect trades, but they will gather more profits on the trend continuation trades. And once the larger trend changes, they are still able to reverse and trade in the other direction once they see a larger change in trend. Risk-reward ratios. Many retail traders do not understand risk-reward ratios and conveniently disregard this most important factor of trading. With all the skills and with all the knowledge, trading financial markets will never show 100% successful trades. There will be misses and hits. Forecasting and trading markets is a science of probability, and it can never be 100% perfect. That said, we can still make speculation and trading probabilities a winning proposition by putting the risk-reward ratio in our favor. Assume that we are the most average traders and we lack any special skill or knowledge. The law of averages guarantees that we will still be correct half the time. Now assuming we are beset with the worst abilities, we will still be correct about 30% of the time. No one can escape those odds. Correct only 30% of the time. With a little understanding, we can put this worst odd also to our favor. How? We execute no trades where the risk-to-reward ratio is less than 1:4, meaning for every dollar we risk, we will look for a $4 profit. Assuming we execute 100 trades and 70 of them hit out stops, we are saddled with a $70 loss, and the other 30 trades yield us a profit of 30 into $4, $120. In effect, we will still net a profit of $50 after being incorrect 70% of the time. Money management. Most professional traders risk only 1% to 2% of their portfolio on any trade, however promising the trade may appear. The retail trader and the unskilled trader, on the other hand, has only 1 to 2 trades, and the risk thereon is more than 10% to 20% of their portfolio value. Risking just 2% on any trades allows the professional trader the luxury of executing 50 consecutive trades before he is totally wiped out. The odds of 50 losing trades in a row is 1 in a million, and no man can execute a million trades. Hence, we assume risking 2% of portfolio on any trade will keep us in the game of trading forever. Another point to note is with a risk-reward ratio and a 2% risk on any trade. Every winning trade adds 8% to the portfolio. And sooner than later, when the string of successful trades are seen, we will have multiplied our portfolio many times over. We see that the most commonly understood rules of the market are misrepresented and lead us to take a wrong choice and trade in the wrong direction of the market. We only need to understand the larger trend and the true language of the market to be on the right side of the market. Open positions, central bank interventions, interest rates, overbought or oversold conditions, earning analysis, price of crude oil, inflation, activity of HNIs, and many more are just several factors that do not lead us in any way to be able to forecast the trend of the market with any amount of certainty. Magic of the markets. Commodities have been traded from centuries. We hear in the Bible stories of wheat, barley, and many agricultural produce being traded. The first person who worked extensively with numbers and the patterns in numbers is Pythagoras. He was the first person to talk about the number squares, cubes, and triangular numbers. These number patterns reflect in the markets, and we can see them working efficiently, and they too can be used to forecast the market's turns and trend changes. A brilliant example can be shown with the chart of COMEX silver that vibrates to the squares of natural numbers. See this monthly chart of COMEX silver. The top in 2011 is 49.8. This is the square of 7, that is 7 times 7, and equals 49. From here, it drops to the square of 5, that is 5 times 5 equals 25. Silver prints a low of 26. The bounce from there takes it to the square of 6. 6 times 6 equals 36. Then it declines again to the square of 5. 5 times 5 is 25. It rallies again to the square of 6. 6 times 6 is 36. Drops again from there to the square of 5. 5 times 5 is 25. And rallies for the last time to the square of 6 yet again. 6 times 6 is 36. And now it breaks the square of 5. Where do you think this will go down to? Yes, of course, the square of 4. 4 times 4 is 16. If you only knew this pattern of the numbers, imagine the wealth you could have accumulated. Like everything in the universe, we humans also appear to be behaving in patterns. And once we observe the patterns, we can safely assume these patterns will be repeated again. Let us look at another method of understanding the markets, the so-called mysterious Gann system, which is simple arithmetic. He said, price and time are interchangeable, and price becomes time and time becomes price. What did he mean, and what did he want us to understand? This is best illustrated with an example. Nifty posted a top of 6,347 on January 8, 2008. Then it declined to 2,252 on October 27, 2008. The difference between the high and the low is 4,105. This number of points, or price as we call it, we will now call it days. So, it's now 4,105 days. Now add these number of days to the low date of October 25th, 2008. And what do you get? Yes, January 18th, 2020. It was a Saturday And what happened on the next trading day following that? Nifty puts in a top and collapses 30% from these levels. Thus, price got converted to time here. Now, let's take another method where we will convert time to price. Nifty all-time low till date has been 775, printed on December 4th, 1996. From here, it rallied to 6,347 on January 8th, 2008. The total number of days it took for this entire rally was 4,052 days. Now, call this number of points. And now, we simply deduct this number from the high price of 6,347. And the result? Yes, 2,295. And what did Nifty do? On October 27th, 2008, it posted 2,252, and that price has not been seen again for the next 12 years. Simple and magical. There are many methods of trading the market precisely without paying attention to the external news, events, indicators, and all the derivations. In this video, you have seen illusions, the three kinds of illusions, the common illusions of the financial markets, what drives markets and prices, magic of the markets, timing the markets, and what skills are required to trade successfully. If you wish to learn more, check out my other free courses on YouTube and on my website www.anantacharya.com. Thank you, and may your trading